Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money side of things. And in this filing, we're going to see how Oppenheimer Holdings performed in the quarter ending summer of 2025, and if they managed to navigate the turbulent economic waters, because let me tell you, some of the things happening in the world right now are wild to Oppenheimer Holdings Inc. The company behind the famous brokerage firm is out with its latest quarterly report. And folks, when I say they had a busy quarter, I mean we're going to dive into their financials, their risks, and what this all means for their future, so buckle up. All right, let's jump right into the numbers. First off, Oppenheimer Holdings Inc. had total assets of a staggering $3.7 billion at the end of June 2025. That's up from around $3.4 billion at the end of 2024, showing healthy growth in what they own. They are holding a solid $37.6 million in cash, which is always good to see in any economic climate. And customers owe them a hefty $1.3 billion, which is a key part of their business. Though they do set aside about $169,000 just in case some of that doesn't come back. Now, the securities they own are worth a massive $1.26 billion, and a good chunk of that is pledged to make sure they cover their obligations. On the other side of the coin, their total liabilities are around $2.8 billion, which is a noticeable jump from the $2.5 billion at the end of last year, meaning they've taken on more obligations or borrowed more money. Specifically, their bank call loans, which are basically short-term loans from banks shot up to $323.8 million from $252 million. That's a big jump, showing they're using more debt to fund operations. And get this, they've sold securities they don't actually own yet, increasing to over $23 million from about $99 million last year. This means they're betting that the prices of these securities will go down. But look at the positive side. Oppenheimer Holdings' total stockholders' equity has grown to nearly $900 million, up from $850 million, indicating that despite the increased liabilities, their overall ownership value has increased. That's the kind of growth investors like to see. Now let's talk about how much money they actually made in the second quarter of 2025 compared to 2024. Total revenue for the latest quarter was about $373 million, up from roughly $330 million a year ago. That's a healthy increase of just over 12%, driven by several factors. Commissions alone jumped to $110 million from $97 million, showing more trading activity from their clients. And advisory fees also saw a nice bump up to $125 million from $117 million. This is likely tied to their growing assets under management. But the real star here is investment banking revenue, which surged to over $43 million from just under $30 million. That's a massive 46% increase, showing they are winning more deals like mergers and helping companies go public. On the flip side, bank deposit sweep income dipped to 28.20 to 28.6 million from 34.8 million. This is probably because interest rates are a bit lower now, so clients are moving their cash to other places for better returns. Now let's look at expenses total. Expenses went up by about 8% to $340 million from $314 million. A big chunk of that increase comes from compensation, which went up to $239 million from $220 million. This indicates they're paying their people more, possibly due to stronger performance or hiring more staff. Despite the higher expenses, their net income more than doubled to $21.7 million from $10.33 million a year ago. This is a really strong performance, showing they are effectively managing their costs, even with the business growth. And that translates to diluted earnings per share of $1.91, up from $0.92 a year ago. That's a fantastic improvement for shareholders. Looking at how their equity changed over the first half of the year, we see a bit more detail on how the company is growing and rewarding its shareholders. Additional paid-in capital is up, showing they are bringing in more capital, likely from stock issuances related to employee compensation or other stock-based plans. Retained earnings have also increased significantly, reflecting the profits they've kept in the business, which is a sign of good financial health. Now, the cash flow statement, which tells us where the money is actually coming from and where it's going. For the first 6 months, Oppenheimer used about $51.7 million in operating activities. This might sound bad, but in the financial services industry, it's common to use cash during growth phases as the business expands. However, they brought in a significant $57.4 million from financing activities, which helped more than cover those operating outflows. This was largely thanks to increases in bank hold loans and other financing mechanisms. As a result, their overall cash and cash equivalents increased by about $4.5 million for the 6-month period. A much better outcome than the previous year's similar period, where cash actually decreased slightly, a great sign of improving liquidity. Digging into the notes here, we find a lot more context about their operation. They have notes receivable totaling $64.3 million, some of which are loans to employees, likely for recruitment or retention purposes. These are generally paid back over time as the employee stays with the company. The company has lease assets on its books totaling $127.2 million, mostly for office spaces around the world. This shows they have a significant physical presence. Interestingly, they have nearly $2 million in new leases that haven't even started yet. That's a pretty big jump from the $6.9 million at the end of last year, indicating future expansion plans. Let's touch on their fair value measurements. The company uses a 3-level system to value its assets and liabilities. Level 1 is the easiest based on readily available market prices, while level 3 involves more complex estimations. You can see the breakdown here with most of their securities falling into level 1 and level 2, which is good because it means their values are relatively transparent. Looking back at 2024, we see a similar pattern with most assets and liabilities valued through observable market data. They do have some level 3 assets which are harder to value, but these are relatively small portions of their total holdings, like auction rate securities and certain corporate equities. Now for my take on Oppenheimer Holdings. When you look at the revenue growth, especially in investment banking and commissions, it's clear the company is having a strong operational period. The increase in total revenue by 12.9% for the quarter is impressive. However, their compensation ratio in wealth management is around 53.7%, and while it decreased slightly from last year, it's still a significant portion of their revenue. This signals that while they are growing, the cost of their talent is a major factor in their profitability. The non-compensation ratio also increased, suggesting higher operating costs, which could be due to technology investments or general inflation impacting their expenses. The capital market segment is still showing a pre-tax loss, although it's a much smaller loss than last year, which is a positive trend, but it highlights the volatility and competitive nature of that business area. Looking at the pre-tax margin for capital markets, it's negative, meaning that segment is costing them money to operate, which is pretty common given the nature of trading and investment banking, but it's important they continue to manage these losses effectively. The company is growing its book value per share to $85.27, which is a solid indicator of increasing intrinsic value for shareholders, even if the tangible book value per share is a bit lower due to intangible assets like goodwill. Overall, Oppenheimer Holdings seems to be navigating the current financial landscape fairly well. Their revenue is up, their net income has significantly improved, and their equity is growing. This suggests a company that is adapting and performing in a challenging environment. The increased reliance on bank call loans is something to watch, but their strong equity position provides a buffer. Alright, that's our breakdown of Oppenheimer Holdings' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.